Hi, this is Ben Reynolds with Sure Dividend. Today we've got an exciting presentation on how to generate rising passive income through dividend growth investing. We also have Nick McCollum on the line. He's available over the chat function. So if you have any questions at all as I go through this presentation, feel free to type them in the chat box and Nick will be there to give you an answer. I also wanted to say thanks for being here. And we also have an exciting opportunity for webinar participants at the end of this presentation, so please stick around for that. With that said, let's jump right in. We're going to be talking about today, we're going to talk about how to generate rising passive income through dividend growth investing. And we're going to go over that in 4 separate sections. The first is the why. Why dividend growth investing instead of other strategies? The second section is how to use dividend growth investing to generate rising passive income. This is the actual how as opposed to the why. The third section, we're going to go over our strategy, the 8 rules of dividend investing. And these are 8 rules that are based on factors that have either historically improved returns or reduced risk. And they're also based on common sense ideas as well as back-tested academic approaches. And finally, as I said earlier, we have an exclusive opportunity for webinar participants. So why dividend growth investing? The idea behind dividend growth investing is really to build rising passive income by investing in companies that are likely to continue increasing their dividends over time. And so this puts your focus both on current income and income growth. And this makes dividend growth investing suitable for both retirement and early retirement. So whether you're building a portfolio for income in the future or you need income today mixed with rising income in the future, dividend growth investing might be right for you. And when you think about it, inflation eats into static dividends. So if a stock just pays, say it pays 5% a year, and it pays that exact same dividend every year, never pays a rising dividend, the purchasing power of that will decrease over time due to inflation. So really, everyone needs rising dividend income, at least to offset inflation, and preferably faster. We're going to go over why to buy individual stocks instead of mutual funds or index funds, because that is a lot of investors think, how can I build a diversified portfolio without using mutual funds or index funds? And it's actually not as difficult as you might think. And we're also going to go over why I choose dividend growth investing over other investing strategies. So why buy individual stocks? The primary reason is, especially in today's market, passive investing strategies like mutual funds or index funds, and even some of the actively managed funds, they force you to buy overvalued stocks. So the market today, the S&P 500, is trading at one of its highest price earnings ratios ever. So it's historically overvalued. And if you're buying a basket of stocks when the market's historically overvalued, you're likely to be buying a lot of individual stocks that are overvalued. So when you buy, say, the S&P 500 index fund, you're automatically investing into many securities which by definition are historically overvalued. And price is what you pay, value is what you get. It's not a good idea in general to invest in overpriced securities. So you can see some the price earnings ratios of some overvalued stocks below. Apple might not be overvalued, but you look at Amazon or you look at Google or Microsoft, these are companies that have high price earnings ratios, even Warren Buffett's Berkshire Hathaway. So they might not be good investments now. And if you're indexing, you're going to be investing in these, especially if you're in a market cap weighted index. If you're investing in individual stocks, you can pick and choose what stocks you own, so you don't have to buy lots of overvalued stocks. You can avoid them. In addition, buying individual stocks means you're going to be avoiding investment fees. So index funds charge fees. Many mutual funds charge excessive fees. And you can see in the table below Forbes' estimates of the real cost of owning a mutual fund. And it's actually quite high, especially when you consider the total returns of the market over the long run are around 9%. So you're giving up roughly a third to almost a half of your returns by investing in one of these high fee products. And sure, it's easier, but is it really worth giving up 30% of your returns? I would say no. This image here shows the growth of your money over time by paying fees versus not paying fees, and just different levels of fees. So you can see that over the course of an investing life, this really adds up, and it makes sense to minimize your fees as much as possible. And that is a big advantage to investing in individual stocks. And one of the, I would say, the myths about investing in individual stocks is that it's difficult to create a diversified portfolio, and you're kind of putting all your eggs in one basket, you're taking excessive risks, and that's really not true. It's quite easy to create an appropriately diversified investment portfolio by buying individual stocks. You don't need to own 500 stocks to be diversified. In fact, most of the benefits of diversification are achieved through owning as few as 20 stocks. And we're going to discuss diversification and this 20 stock, it's not a rule, but owning 20, 30 stocks versus 500 more a bit later in this presentation. But it's definitely something to keep in mind that you don't need to own 100 or 500 stocks to be diversified. That, I would argue, is being seriously over-diversified and investing in your 100th best idea instead of your best idea. And that is a interesting thing to think about. It's your choice what you invest in. Why would you invest in your 50th best idea when you can invest in your best idea? Or even if you're owning 20 stocks, if you're building your portfolio over time, you're investing in your best idea at one time, maybe over a 20-month period. So if you're indexing, you're really not investing in your best ideas. And an analogy would be, if you're going to go see a movie, you wouldn't want to go see your 20th favorite movie that you haven't seen. You see the movie you think you're going to enjoy the best. And that's kind of the same with investing. Put your funds into your best ideas, not your mediocre ideas. So why dividend growth investing? It's conducive to long holding periods. Dividend growth stocks are stable businesses with strong competitive advantages, just in general. Of course, not all of them are, but for a business who increases dividends over long periods of time, it must have at least recently had, if not still, does still have a strong competitive advantage. So that's something to keep in mind, that a company can't increase its dividends for 30 years in a row unless it has a strong competitive advantage. It's impossible. It wouldn't be able to pay out more money every year. And Seth Klarman, who's the billionaire founder of the Baupost Group hedge fund, this is an excellent quote. The single greatest edge an investor can have is a long-term orientation. So this is one of the best investors of our time saying, the best thing you can do is think long-term. That's more important than anything else in investing. And it ties in perfectly with dividend growth investing, because we need to think about the long-term nature of these businesses. Will they pay us rising dividends 10 years from now, 20 years from now? And if you're only thinking about the next quarter, you're not even going to consider that question. So a long-term mindset is important, and it changes the people you're competing against. So with a short-term mindset, if you're looking at, is Apple going to beat its earnings estimates in the next quarter? Some of the smartest people in the world are working on that problem. There's tons of quant funds that are working on that problem. The shorter the time frame, the more competition there is, because the markets are fast-paced. And results, if you're managing money institutionally, quarterly results matter. If you underperform for a quarter or a month, you look bad, people leave your fund, and you're making less money yourself. But when you're managing your own money, you don't need to beat anyone over the next month or next quarter. That doesn't matter. You need to do well over the course of your investing lifetime. You need to build rising income over time, not rising income next month. And so that's really a differentiator with dividend growth investing versus a lot of other investing strategies. And this also enables you to spend less time watching your portfolio. You don't have to check in every day and say, oh, my shares are down 1%. Should I sell? You can say, okay, well, this company's still paying the same dividend it was yesterday. Nothing's changed about the fundamentals of the business. That 1% price change doesn't matter. Long-term investing also allows you to legally defer capital gains taxes. So this is when you sell a position you're up in. You sell a stock, you're up 100%. That's, first off, congratulations, that's exciting. When that happens, you have to pay capital gains tax. So that money you paid in capital gains tax is no longer working for you. It's basically like paying fees on a managed fund. that's money out of your pocket and into someone else's. And you want the money in your investment account to stay in that account and build wealth for you and compound over time. So if you don't sell, you don't owe those capital gains taxes, and that money you would have paid out is left in that investment to continue compounding for you. And I believe that's one of the big reasons Warren Buffett talks a lot about not selling and having super long holding periods. And long holding periods do also let you take advantage of compound interest, because as we just discussed, you're not selling, you're letting the business work for you and letting the business's growth work for you. And dividend growth investing is at its core a very simple strategy. You don't have to be a rocket scientist to understand dividend growth investing. You're looking for strong businesses that make real money, that pay that money out to shareholders, and that are likely to continue growing and paying out more in the future. And we're going to look at these items on a per share basis and not a business basis. And the quote below from Warren Buffett, it really succinctly sums up his strategy, and it ties in very nicely with dividend growth investing. So Buffett says that Berkshire selects investments on a long-term basis, and there's that long-term, like what Seth Klarman was talking about, how important that is. On a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. So this is Buffett's just saying, buy stocks like you're going to invest in an actual business, because they're actual businesses. 1, favorable long-term economic characteristics. Will it be bigger in the future than it is today on a per share basis? 2, competent and honest management. Is management shady? Have they been involved in frauds in the past? Are they interested only in growing the size of the business and not increasing value on a per share basis? Are they aligned with shareholder interests? 3, a purchase price that is attractive when measured against the yardstick of value to a private owner. So this is very important. Don't overpay. Buy a stock like you would an individual business. Pay based on the income stream it can produce and on its market position. And 4, you get to pick what industries you invest in. You don't have to invest in commoditized industries. Or industries that you're not familiar with. So if you're not into biotechnology, you don't need to invest in biotech startups. An industry which you are familiar and whose long-term business characteristics we feel competent to judge. And so some businesses and industries are easier to understand than others. Consumer brand companies. It's pretty easy to understand that Kimberly-Clark sells Kleenex. Kleenex is a strong brand. People buy Kleenex and then they have to rebuy it, and they tend to not buy other brands. It doesn't take a genius to figure out how they make money or how they protect their brand through advertising. So, but again, a biotech company, I don't understand how that works. It's who knows if it will be valuable, especially if it's a startup. So, I'm not competent to judge that, and I wouldn't say, oh, well, other people are doing well with this. Other people are doing well with this strategy. I need to jump into it. Do what you know, not what other people are doing that's working for them right now. Because if you don't understand it, you're not likely to stick with it when it doesn't work for a period of time. And all strategies go through periods of underperformance. So it's important to believe in what you're doing. So, and with Buffett's strategy here, if you basically just added in rising dividends, which ties in really well with point 1, it's dividend growth investing. And dividend growth investing has psychological benefits. So as we were talking about just in the previous slide, being comfortable with the industry you invest in and being comfortable with the companies you invest in. Johnson & Johnson has increased its earnings per share, not even its dividends, for I believe 30 or over 30 years in a row. It's increased its dividends over 50 years in a row. It has a ton of well-known consumer brand products, and it has a gigantic pharmaceutical division. It's a super established company. Almost everyone's familiar with it. If you're invested in Johnson & Johnson and you see the stock price go down 5 or 10%, it's a lot easier to say, okay, they'll be okay. They had a one-time earnings miss, or people are just scared about, whatever the fear of the month is here. And if anything, it's a buying opportunity. If you own a business you don't know, XYZ biotech stock, or some startup, or just it could be any business really that you're not familiar with, and you see the stock price decline 10% or more, and suddenly panic sets in and you need to sell because what does that mean? I don't know. So if you know the business, you have a big advantage over people who don't know the business in that you're more confident in it and you can hold during downturns. And I think that is the single biggest issue that investors make is selling when prices are down rather than buying. And so if you know the business, you're more likely to hold during those downtimes or buy. And you can see these are all stocks that pay rising dividends. Many of them have paid rising dividends over 50 years in a row. It'd be Johnson & Johnson, Coca-Cola, Hormel, out of this list, and Procter & Gamble and Colgate-Palmolive. Some have paid over 25 years in a row. Abbott, if you don't count spinoffs. McDonald's is in the 40s, I believe. Same with Walmart. And then Walt Disney, Starbucks, and Nike have slightly not quite as long of dividend histories as these other brands, but still they have great dividend histories and they're well-known brands and they're likely to continue growing. And actually those three are probably growing faster than the others, with the exception of maybe Abbott grows fairly quickly as well. It has recently. But still, I'd expect Nike and Starbucks and Disney to an extent to grow faster than the rest of these. And that doesn't say anything about the value, so I'm not recommending those right now, just kind of as a aside. So that covers section 1, the why. I think there's a lot of advantages to dividend growth investing, and if there's any questions later on, I can go through those as well. Section 2, how to make the most of dividend growth investing. So this is the how to diversify your investment portfolio, which we briefly touched on. We're going to go into more detail. How to reinvest dividends. Do you drip the dividends or do you reinvest into your best idea? How to find high quality investment opportunities by creating a systematic investing strategy. And we have our own strategy at Sure Dividend. You don't have to follow our strategy. You can make your own. We put a lot of research into ours, so we're going to present that later on as well. On diversification. So diversification is often touted as the downside to investing in individual stocks. But it's really not true. Most of the benefits of diversification are achieved from owning as little as 20 stocks. And the image below there, you can see that as the number of holdings you have increase, the marginal gain of diversification falls with each additional stock. So you can see that really bottoms out around 20 securities, and there's negligible gains after really 50, but I mean 30 basically even. So if you move your portfolio from 499 stocks to 500, you haven't really gained any diversification benefits. They'd be astronomically low. You gain huge benefits, and I don't recommend this, but if you had one stock in your portfolio and you went to 2, you gain tremendous diversification benefits. But there is kind of a sweet spot of around 20 to 30 that is a nice trade-off between getting diversification. So if you make a mistake, and everyone makes mistakes, no, we can't see the future. We're going to have investments that don't work out. Everyone does. When that happens, your whole portfolio is not sunk. But at the same time, you can invest more into your best ideas at 20 to 30, and your gains will have some impact on your portfolio. This is another thing with diversification. If you have 100 stocks and one of them doubles in value, your portfolio is up 1%. So that's not really exciting when you look at it on a portfolio level. But if you had 20 stocks, your portfolio would be up an additional 5%. So it's a significant advantage to owning fewer stocks that you're more confident in, while you still get most of the benefits of diversification. And obviously, with this said, you have to, owning just 20 stocks, if you own 20 oil and gas stocks, you're not diversified. You have to have some sort of reasonable common sense diversification between industries and sectors. Again, investing in ones that you understand reasonably well. It takes less confidence to invest in ExxonMobil than it does to invest in a small oil and gas exploration company. So there is benefits to investing in the strongest businesses around that are easier. It might be more difficult to understand if you were looking into every nuance of the business, but they're easier to understand their competitive advantage than a very small company. But it does make sense to diversify among industries and sectors in a common sense way, so you're not exposed to just risk of oil prices falling, or you're not exposed to healthcare reforms. You're exposed to a lot of different risks, and you're diversified there. But the key takeaway here is really 20 to 30 stocks gives you most of the benefits of diversification that you get from 500 or 5,000 stocks. And I touched on this already, but investing in your best ideas makes a lot more sense than investing in your 100th best idea. We don't do that in our normal lives. This is not how people live their lives, but for some reason it's touted as a good idea in investing, and that doesn't really make sense. And the Warren Buffett quote below, diversification is protection against ignorance. It makes very little sense for those who know what they're doing. And I do think there is a trade-off. The less you know about investing, the more diversification you should have. And the more you know, the less diversification. So Warren Buffett's right-hand man, Charlie Munger, I believe he has 3 stocks in his portfolio. He's obviously an amazing investor, but no, that's very aggressive, and I would never recommend that. I don't do that personally. But I'm also not Charlie Munger, and he's done phenomenally well, obviously. So that does show the more comfortable you are with your investments, probably the fewer securities you're okay to hold. But it's always good to be humble and know that the odds of being one of the greatest investors of all time, pretty low. So probably 20 to 30 stocks is a nice trade-off there. Dividend reinvestment. So in the dividend growth community, there's a dripping is very popular. So DRIP stands for Dividend Reinvestment Plan. It just means that if Coca-Cola pays a dividend, instead of taking that dividend in cash, you take that dividend and immediately buy more Coca-Cola shares with it. So if Coca-Cola has a 3% yield, you'd be getting 3% more Coca-Cola shares every year. And you still owe taxes on those dividends if this is a taxable account. So it's not like a way to avoid taxes on dividends, unfortunately. Yeah, so that's the advantage of dripping is that you're reinvesting your money. You're not probably tempted to take out of the account. The disadvantage is, again, you're not investing in your best idea. You're just reinvesting in the company that paid the dividend. So if you bought Coca-Cola 20 years ago and maybe it was a phenomenal buy then, maybe today it's overvalued and you don't want to buy more Coca-Cola. Maybe you see a lot more value in a different dividend stock. Maybe you want to buy Cardinal Health instead, or Walgreens. Instead of reinvesting Coca-Cola's dividend back into Coca-Cola, take their dividend and buy some Cardinal Health or some Walgreens, or a company you feel is undervalued today that still has a lot of dividend growth potential. Walgreens, or a company you feel is undervalued today that still has a lot of dividend growth potential. And that's why at Sure Dividend, we recommend selectively reinvesting your dividends on a periodic basis into your most compelling investment opportunities. Creating a systematic investing plan. So investing in individual securities, it's certainly doable. It can be absurdly complicated if you go into extreme detail. If you have a systematic investing plan, it can really help to make the smartest decision when you need to. So when stock prices are falling, if you have an investment plan and you're prepared ahead of time, maybe you'll panic sell less often. If you have a plan on knowing what stocks to buy, you'll do better with, okay, well, I have funds to invest. Here's what I'm going to buy. I know ahead of time. And so it really reduces biases and errors if you have an investing plan, because you're taking away as much emotion as possible from your investing by planning it out ahead of time. What we do at Sure Dividend is we prefer a screen that uses factors that have historically either improved returns or reduced risk in creating an investing plan. Some examples of these type of factors would be value, so a low price earnings ratio, low stock price volatilities, or high dividend yields. Investors in the accumulation stage, so these are people, if you're not yet retired, you're not looking to take money out of your account, you're still adding to your account. If you're in the accumulation stage, you should contribute a fixed amount each month, regardless of market conditions. This is dollar cost averaging. If you're retired, it'd probably be better to do a brief portfolio review monthly. A systematic plan allows you to avoid the behavioral errors and reduce behavioral errors that reduce long-term total returns. Kind of ironic that I said had a little error there while I was reading a sentence on behavioral errors. Systematic investing and cognitive biases. Investors succumb to numerous cognitive biases that impair their ability to achieve long-term investing outcomes. A few examples are below. And just before I get into these, everyone makes mistakes. Some mistakes are unavoidable. Mistakes from emotions, from not planning, from not being prepared are avoidable, and minimizing those should increase our returns over time. And it's all humans suffer from these, or maybe there's someone that doesn't, but basically everyone does. If you didn't, it's probably that's not normal. Examples are below. Confirmation bias, believing research that confirms existing beliefs while ignoring research that goes against our point of view. And this is extremely interesting, and everyone suffers from this, I believe, to some degree, and it's very hard to fight against. So when we have an opinion, we have our minds made up about something. So if we say the sky's purple, and someone says, no, look up, it's blue, you might be like, no, it's still purple. We really want to fight conflicting evidence, even if the evidence is compelling, rational, and goes against our erroneous wrong beliefs. We try to protect ourselves from changing our mind, basically. Loss aversion is another one. People tend to dislike losing a dollar much more than gaining a dollar. So on a absolute basis, it's the same thing, but for psychologically, it hurts to lose money more than it feels good to make money. Trend chasing bias is the tendency to chase historical returns despite the logical knowledge that past performance is no guarantee of future results. And it's an interesting phenomenon. In the short run, the momentum effect says that a security that is going up actually is more likely to outperform over short time frames. But over long time frames, the opposite is true. Undervalued stocks outperform. So it's really kind of a trade-off there. If you're investing for the long run, you want those undervalued securities. If you're investing for the next month, you want to chase that hot stock, but that has a lot of trading costs. You're competing against a lot of people, and I don't believe it's the wise move to make. Plus, it's more stressful. So overall, trend chasing, I believe, is inferior to value investing and investing kind of with the idea of you're investing in real businesses over long periods of time. And that covers section 2. Section 3 discusses our system for dividend growth investing, the 8 rules of dividend investing. It's a systematic investing program that eliminates behavioral biases and improves, and we use factors that have historically improved long-term results. To that end, Sure Dividend created the 8 rules of dividend investing, and this it's 5 buy rules, 2 sell rules, and 1 portfolio management rule that take advantage of, as said before, factors that have historically improved returns or reduced risks. The first rule, and we're going to go over the 5 buy rules first. So the first rule is the quality rule, and this is the Seth Klarman quote we went through earlier. Is one of my favorite investing quotes, so it's good to have it in here twice. The common sense idea here is to invest in great businesses that have a proven record of stability, growth, and profitability. So some of those businesses we showed in an earlier slide, and of course price matters here, so these aren't recommendations, but in general, the Johnson & Johnsons, the 3Ms, the Coca-Colas, the Hormels, the strongest businesses around that have not the strongest businesses of the last year, not Facebook, but businesses that have been proven they can withstand tons of different market conditions over 20, 30, 50 years. And they've paid rising dividends over this time. And what we do with the 8 rules of dividend investing is we rank stocks by their corporate and dividend histories. And obviously we prefer longer to shorter. The evidence behind this is the Dividend Aristocrats Index, which are stocks with 25 plus years of consecutive dividend increases. The Dividend Aristocrats have outperformed the S&P 500 by over 3 percentage points a year over the last decade. So that's phenomenal outperformance, and they've done this outperformance with slightly less volatility, and importantly with much better performance during the Great Recession. I believe in 2008 the Dividend Aristocrats Index was down 22% versus 37 or 38% for the S&P 500. So really high quality businesses, yes, their stock price does go down during recessions when the stock market's tanking. So it's not like they just a straight line up forever. The stock price goes down, likely to go down less than the average stock though. So that's important to know. So it is a bit easier to hold them, but there is still volatility there, just less in the overall market historically. The second rule is the bargain rule. Price is what you pay, value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. That's a Warren Buffett quote. So apparently Warren Buffett, as a multi-billionaire, I'm sure when he had this quote, was still comparing stock prices. That kind of speaks to the mindset of some of the wealthiest people in the world. Comparing stock prices, in addition to obviously stock prices. So the common sense idea here is to invest in businesses that pay you the most dividends so you can increase the cash flow generated from your investments. So all things being equal, I'd rather have a 5% dividend yield than a 1% dividend yield. And what we do here is we rank stocks by their dividend yields. The higher the better. So this is not the only thing we look at. A high yield with a very high payout ratio with no growth can be actually a very bad sign. But all other things being equal, the higher the yield, the better. And the empirical evidence here is the highest yielding quintiles, this is the top 20% of high yield stocks, outperform the lowest yielding 20% of stocks by 1.8 percentage points from over a very long period of time, a 75-year period of time. So that's obviously a very robust result that on average over the long run, high yield beats low yield. Rule 3, the safety rule. An excellent Benjamin Graham quote. The secret of sound investment is 3 words, margin of safety. The common sense idea here is to buy overvalued stocks, is not to buy overvalued stocks. The common sense idea here is buying overvalued stocks eliminates your margin of safety. Stocks that are repurchasing significant amounts of their own shares are likely to be undervalued. And so if you think about it, if a company's management is gobbling up tons of their own shares, this is not they're buying back 1% a year, they're buying up large portions of their own shares, tells you either 2 things. The management is not very smart or the company is very undervalued. Typically it's very undervalued. And so we rank stocks by their share repurchase yield. The higher the better. And there's actually a safety component of share repurchases that's interesting and worth noting. So if a company is repurchasing shares and paying dividends, and it has a long history of rising dividends or even steady dividends, if that company gets into temporary trouble, what do you think it's going to cut first? It's dividends, which it's established over 20, 30 years, or it's share repurchase, which people don't track. No one tracks the companies repurchase more shares every year over 20 years. So they're going to reduce their share repurchases first. So it's actually a buffer on the dividend payments if the company has enough cash to repurchase shares while it's paying a dividend. So that buffer makes companies that are repurchasing their shares safer on average than companies that aren't, in addition to possibly signaling, again, a valuation, an undervalued status. And the empirical evidence for this is the S&P 500 buyback index, which covers stocks that are repurchasing their shares, has outperformed the S&P 500 by a tremendous 3.6 percentage points a year over the 10-year period ending in November 2017. This is a high level of outperformance. Companies that repurchase their shares tend to significantly outperform. And this is interesting, just as an aside, these tend to not be the high growth companies of the world. These tend to be established businesses that are generating a lot of money, and really they don't have, in some cases they don't have enough places to put that money, so they're paying a dividend, they're buying back shares. And it's interesting that people think about these boring businesses as low growth investments when they actually tend to generate superior total returns. So if you want growth in your investment account, sometimes the boring businesses, if they're purchased at attractive prices that make tons of money and are giving that money back to shareholders, do well. And it makes a lot of sense when you think about it, because they're actually returning money to shareholders. Rule 4 of our ranking factors for buying is the growth rule. The Peter Lynch quote here is, all you need for a lifetime of successful investing is a few big winners. And if you do have a stock that grows quickly over a long period of time, you're going to do very, very well thanks to the power of compound interest. So the common sense idea here is that investing in businesses that have histories of solid growth and high likelihood of delivering strong growth moving forward makes sense. The quantitative rule is to rank stocks by their earnings per share growth estimates, or revenue per share growth, or dividend per share growth, depending on the situation. And what the empirical evidence behind this, so the idea here is invest in stocks that are growing. Again, all things being equal, We like to prefer stocks that have a history of growth on a per share basis, and it's always important to make that distinction. We invest in businesses when we're buying shares, but we're investing in shares. So we don't, no one's buying whole businesses here. So when you're buying stock, you own an individual share. If management is diluting shares and they're issuing shares, you own a smaller percentage of the company every time they dilute your share ownership. So a business can grow and shareholders can do very poorly if the company's management is issuing lots of shares and diluting shareholders. So always judge growth on a per share basis. Stocks with growing dividends, and empirical evidence here for stocks that are growing tend to outperform stocks that aren't, all things being equal. And it's important also to say it's not good to pay for growth. You don't want to pay a price earnings ratio of 40 just because the company's growing quickly. But the empirical evidence is stocks with growing dividends have outperformed stocks with unchanged dividends by 2.4 percentage points a year from the basically 41-year period from 1972 through 2013. Rule 5 is the peace of mind rule. And this quote from David Reynolds says, "Psychology is probably the most important factor in the market and one that is least understood." And the common sense idea here is that we look for businesses that people invest in during recessions and times of panic. They have relatively stable stock prices that make them easier to hold for the long run. You don't get long-term benefits if you're not holding for the long run. And again, all things being equal, it's preferable to make it easier to hold for the long run, and that means lower volatility, lower stock price volatility. So we rank stocks by their long-term volatility, the lower the better. And there is empirical evidence behind this as well. The S&P 500 Low Volatility Index, these are stocks with lower than average volatilities, have outperformed the S&P 500 index by 1.9 percentage points per year through the 10-year period ending November 30th, 2017. And this just flies in the face of what you'd expect, right? We've always been taught the higher the volatility, the higher the returns. In real life, not the case. In fact, in the stock market, the lower the volatility, the higher the returns, because volatility, I believe, speaks to quality. Lower volatility stocks like Johnson & Johnson typically are some of the lowest volatility around. And it's one of the strongest businesses around. So low volatility is almost a proxy for quality, and it's showing that this is a strong business. Its share price doesn't move as much. And as you'd expect, better businesses tend to do better in the stock market in the long run. So those are our 5 buy rules. We have 2 sell rules here. The first of which is the overpriced rule. Just before I jump into these, we only have 2 reasons to sell. One is if the company is very overvalued. The other is if it's lost its competitive advantage and it's cut or eliminated its dividend. So Rule 6 covers if a company is very overvalued. So Warren Buffett says, for the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. The common sense idea here is if you are offered $500,000 for a $250,000 house, you should take the money. It doesn't make sense not to. It's the same in the stock market. If you can sell a stock for far more than it's worth, you should, and you can reinvest that money into an undervalued security. We want to sell very rarely, so we've put a very high bar for selling, and that's an adjusted price earnings ratio exceeding 40. So that occurs very rarely. The empirical evidence here is the lowest decile of price earnings ratio stocks. So the 10% cheapest stocks outperform the 10% most expensive stocks, and this is an absurd number, by 9 percentage points a year over a 35-year period. And you can think about the other numbers we've said in this presentation, dividend aristocrats and share buyback stocks. They're outperforming by about 3 percentage points a year, which is huge. 9 percentage points from the highest decile to the lowest decile. This is a tremendous change. If you're investing in high price earnings ratio stocks, you're likely not going to do well based on the evidence of really since there's been investing. And interestingly, people tend to chase performance and they tend to invest in these really high price earnings ratio stocks. It's historically a very bad move. As the 9 percentage point gap below shows, which is incidentally the average return on the stock market is 9%. So if you're it's a tremendous gap. Our final sell rule is the survival of the fittest rule, and John Maynard Keynes says, "When the facts change, I change my mind. What do you do, sir?" I really like that quote as well. And the common sense idea here is if you own a stock that reduces its dividend, it is paying you less over time instead of more. You bought it to pay you more over time. So you must recognize that the business has lost its appeal and reinvest that money elsewhere. And the quantitative rule here is to sell a stock when its dividend is reduced or eliminated. And we don't sell immediately if there's a reduction. It depends on the circumstances. In some cases, we recommend selling immediately. In some cases, we recommend selling when the stock has rebounded some, if it's not something that the business is dying right now, but maybe sort of a one-time event. Still a sell, but maybe wait a bit. But still, the rule here is to sell a stock when its dividend has been reduced or eliminated. And another very interesting piece of empirical evidence, stocks that reduced or eliminated their dividends had a 0% annualized return over from 1972 through 2013. So 0% over a 41-year period is not good. That's very, very bad. So if you want to not make money in the stock market, just invest in stocks that have just cut their dividend, and you're good to go. Final rule, rule number 8, the hedge your bets rule, and this goes back to diversification. The only investor who shouldn't diversify are those who are right 100% of the time. And that's a John Templeton quote. The common sense idea here is that no one is right all of the time. By spreading your bets over different businesses as time goes by, you'll accumulate a portfolio of high-quality businesses to hold for the long run. And we've talked about that 20 to 30 stock portfolio. Maybe a bit more if you want more diversification, maybe a bit less, 20 to 30 in general. The quantitative rule we use to build portfolios is to buy the highest ranked stock you own the least of each month over a period of 20 to 30 months, and then reinvest into the highest ranked stock you own the least in your portfolio to build positions in your portfolio rather than continuing to add stocks. The empirical evidence here is a 1970 study from Lawrence Fisher and James Lorry that 95% of the benefits of owning the entire New York Stock Exchange, so every stock in the New York Stock Exchange, came from owning just 30 stocks. So you might have heard of the 80-20 rule. This is just as powerful, if not more powerful. Similar results have been found by other researchers as well. Excuse me. So a summary from the 8 rules. We have 5 buy rules, 4 of which are shown below. Quality rule, rank stocks by corporate history and dividend history. Bargain rule, rank stocks by dividend yields. Safety rule, rank stocks by share repurchase yield. Growth rule, rank stocks by the earnings per share growth estimates. The higher the better. And finally, the peace of mind rule, rank stocks by their long-term volatility, the lower the better. 2 sell rules, the overpriced rule, sell when an adjusted price-earnings ratio exceeds 40. Survival of the fittest rule, sell stocks that reduce or eliminate their dividends. And finally, the hedge your bets rule, buy the highest ranked stock of which you own the least, and to build a 20 to 30 stock portfolio. Now I want to briefly talk about the exclusive opportunity we had for webinar participants. As a thank you for participating in this webinar, we're offering you a massive discount on our 2 Sure Dividend services. We specifically priced these very cheap to begin with because the goal at Sure Dividend is really to get as many people as possible to benefit from investing in rising dividend growth stocks. The 2 newsletters below, the Sure Dividend newsletter and the Sure Retirement newsletter, are normally $79 a year for either one. And at that price, we really provide far more in value than we take in payment. And with this webinar, we have an offer to get either newsletter for $58 a year, which is savings of $21 a year. Price never increases after joining. So this isn't a bait and switch where it's $58 a year now and then it's $500 a year. We don't do anything like that. It's just $58 a year. And Nick is going to bring up right here order form if you're interested in joining for the Nick, is this for the Sure Dividend newsletter here? I believe this is for the Sure Dividend newsletter, not the Sure Retirement newsletter. But this is for the $58 a year price. Yes, this is for the Sure Dividend newsletter. And with that said, if anyone has any questions they want to put in the chat bar, I'd be happy to answer them. And I'm also trying to think if anything to go over in the newsletter. A common question I get is, where are you seeing value today in the stock market? And as we touched in the beginning of this presentation, okay, here's one question. Was the webinar recorded? Yes, the webinar is recorded, and there will be a replay available. So for those interested, a replay will be emailed to you to watch or rewatch at your convenience. And as I said, as we discussed, yes, historic performance for the newsletter. We started the Sure Dividend newsletter in the first edition came out in April of 2014. Since that time, our actual performance is in the newsletter, and the way I've recorded performance is based on a hypothetical portfolio of if you would have followed our portfolio building guide and invested in the first 30 highest ranked recommendations you own the least over the first 30 months, and that portfolio has outperformed the market. I don't have the numbers in front of me, with less risk in a bull market, no less. So I actually expect dividend growth investing strategies to underperform the market slightly during bull markets. We've been able to outperform. We've also outperformed the Dividend Aristocrats Index over the same time period. But I do expect to significantly outperform during bear markets, and we've outperformed during a bull market too. So that's definitely a good sign, and I've been very happy with the results so far. I've been very happy with the results so far. Another question, does the Sure Dividend newsletter also look for stocks in the Baltics or in the Nordic exchange? And the Sure Dividend newsletter basically is U.S. stocks only. These are all stocks that are traded on the New York Stock Exchange, or they're traded on major stock exchanges in the U.S. So we're not looking really at Baltics or Nordic stocks. We just actually released the Sure Dividend International newsletter, which does focus on global stocks ex-US. So that one would, the Sure Dividend newsletter, which is our primary flagship newsletter, does not focus on Baltics or Nordic regions. Not saying there's not good companies there. It just focuses primarily on US because I guess that's where I'm based, and that's where we did our first focus was. All right, any more questions? And I did want to also just include a couple places we were finding value today in the US. Actually, some branded consumer companies are just starting to get cheap again, which is a rare occurrence, and there's some reasons for that. But we're seeing some value there. We're seeing value with some healthcare companies. Okay, how long will this offer be available? I don't believe we have a deadline on it right now. I don't know off the top of my head though. But there is a 7-day free trial as well. So we don't bill anyone for 7 days because it's literally try it before you pay for it. So if you don't like it, you can just email me or Nick and we'll make sure you within the first 7 days and you won't even be billed. So there's really no disadvantage to trying the newsletter. I just wanted to say based on that question there. But yeah, going back to where we're finding value, in the healthcare sector, there are some values because of the opioid epidemic. Is a scare that people are fearful of that sector. I'm going to get to this question on Coca-Cola shortly. Yeah, so when there's negative news stories, another negative news story specifically surrounding pharmaceutical distributors, and our favorite there is Cardinal Health, which is one stock that we've seen value in for a while. The negative news stories have pushed the stock price down. It also has struggled with a price war within its industry, which is an oligopoly. I believe there's 3 large players in the industry. So it's really an oligopoly. It has a strong competitive advantage. People were scared because what if Amazon comes into the market and then opioid epidemic? There's lawsuits around Cardinal Health. They're minor. They will not affect the company in the long run. But that has pushed down the price and made it an attractive investment. And as a disclosure, I am long Cardinal Health myself. So with that said, what are my thoughts on the Coca-Cola company? I have not looked into the price super recently. My thoughts the last time I looked at it was that it was overvalued. And with Coca-Cola, I don't own Coca-Cola shares. I have PepsiCo shares myself. If I had Coca-Cola stock, I would hold it. I would not sell it. I don't think it's that overvalued. The last time I looked at it, Coca-Cola it's going to be around a very long time. I do think it will grow. It'll grow slowly. I'm sure people listening have seen and heard that soda sales are de- declining in the U.S. and developed countries. So Coca-Cola sales, I haven't checked their latest numbers, but they tend to be relatively flat. Sometimes they're doing a bit better with special packaging and smaller sizes to sell more units and things like that. But the demand there is actually slowly declining. But Coca-Cola knows this. Coca-Cola knew this long before the average investor did. They own 20 or slightly over 20, around 20 brands that do $1 billion plus in sales a year. And there's actually more of those brands that are still beverages, so non-carbonated versus sparkling. And that's very interesting. So they own Simply Orange Juice would be one of them. Vitamin Water would be another. They have lots of brands that are not soda brands that are growing. So will Coca-Cola be around in 50 years? I'm very certain that they will be. Will they be bigger on a per share basis? I'm certain they will be. I think the growth will be relatively slow, and I don't think, from when I looked at the stock price last, I don't think now is the time to buy Coca-Cola stock, but I would hold it, me personally, if I owned it, which is what I'm doing with PepsiCo, which is sort of a similar situation. Bank of America, I don't have any ideas with that one, so I can't help there. I haven't analyzed it recently, and I don't want to say anything that, kind of go out on a limb there. All right, any other questions? All right, well, I appreciate everyone who listened in today. I hope we provided some value here with how to generate rising passive income with dividend growth investing. Feel free to visit suredividend.com to read more of our work. We also have a podcast now called the Sure Investing Podcast at sureinvesting.co. And check us out also on our YouTube channel, which is youtube.com/Sure Dividend. All right. Talk to y'all later. Have a great night.